G'day everyone, welcome back to another episode of Spark Your Fire. I'm your host David Shih, and as always, the myth, the man, the legend, John. How are you?
Hi there,
on this
David.
Good Friday.
Yeah, quite an introduction. I'm well. How are you doing?
Good, mate. Good to have you on as always, mate. I think this podcast would be so bland if it's just me talking all the time. So I'm just so grateful to have your input. And I know that's why most listeners are here, is to listen to you rather than me.
Oh, that's because we throw the odd conspiracy theory out there. You got to give the people what they want.
The controversial part, I guess.
Yeah.
Anyway, welcome listeners. So thank you guys for joining us again. A couple of interesting topics that we want to cover today, but I guess let's just kick off with the July cash rate decision because that's, as they always say, the rate that stops the nation, in a sense. So RBA has confirmed that we are holding rates for July on 4.1%. So there's no increase, which is probably a good sign in a sense. But yeah, I think the minutes haven't been out yet, but I guess looking from the initial press conferences in terms of what Governor Lowe has said, it's one of those ones that last month feels more like an insurance policy, basically, and this month it's more about protecting the economy. I think they're starting to get a bit more concerned about the higher the rates. Now it's really going to start the economy, and we all know that we've been walking on a very narrow path to make sure that we can actually get through without, try to balance out the mortgage payers as well as getting the economy without people losing too much job. So I think it was a decision this time to just make it a bit of a pause, collect the data again, especially I think the quarterly inflation data that's going to come out for the last 3 months, and then assess to see whether there's any potential further rate rise that's still required. So in essence, I think it's just a bit of wait and see approach at the moment to see. Let's just wait for a bit. We'll let the increases, the 4% that has already taken place, to sink in for everyone, give everyone a bit more time, and now we want to see further data to see whether there's any need for further rate rises. The tone still hasn't changed as much, though. I mean, they will still keep it to say we might still need to increase the rate in the future. Like, they'll never say never, to be honest. Right? They will always put that clause on there to say, the further hikes could be warranted, but then again, that will be subject to how the economic data pans out. So anyway, I think it's a short relief for the mortgage owners at the moment for another month. But John, I don't know. What do you think at the moment?
Well, it's not much to say, I suppose. Alan Greenspan, the old Fed chairman, used to say that if I've made a statement and you've understood what I've said, I haven't done my job. So central bankers are sometimes deliberately quite obscure, and they like to keep all their options open. So I think, increasing rates from here and decreasing rates from here is probably equally likely. And if the market's placing bets, they're not doing their job because they're supposed to be obscure. It's good. I like the pause approach. I've always said that if I was an alien coming down from Mars and I landed on Earth and I looked at the economy, I'd say, well, the big problem here is that your interest rates are too low. So I'm pleased that that's been rectified to some degree. I think it happened too quickly, and I think that's a problem. And I don't think we've seen the end of the problems that will come from raising interest rates as quickly as they have done it. But I'm pleased. The pause to me is like, it's like waiting before you go back to the buffet table after you've had a big meal. I think it's good to let the body digest the interest rate increases. The speculation now is whether they're done. Like, is this it? And look, here's what I think that there's one more rate rise, and I think it will happen in the next 2 months. Governor Lowe's he's leaving his post at the RBA, I believe, in September. And I think that, and looking at the 2-year yield, if the 2-year yield is the North Star for interest rate policy, the overnight rate's currently 4.1%, the 2-year yield's 4.3% and a bit. So they probably will raise rates one more time before Dr. Lowe leaves, and that would be my guess. It's hard, and then I think the second half of the year is probably going to be very different, because I think that these resetting of the rates are going to start to have an impact. I actually think that they've probably killed inflation. They've probably done it, but because all the data is lagging, and because what the number that they quote is annualized inflation data, there's all the high inflation from the previous 12 months that is still going to be lingering in the data. So I don't think that there's any rate cuts for at least 6 months, but I think there's some pain to come, and I think there's one more rate rise.
Yeah, no, I think you're pretty much spot on, mate. I think certainly we've passed the peak inflation, but the question now just comes down to: are we bringing it down fast enough? I think that's what the RBA. I think it might be the month or the before. That's the tone that they're saying. We're increasing because the trend or the inflation trend is not dropping down to the target level within our 2024, 2025 range. In fact, it's more 2025 now. So that's why they are putting it up again as an insurance policy. But whether that was too much, or whether that would still allow us to kind of keep the economy on an even keel is going to be an interesting observation. I think the quarterly inflation data will certainly give us a lot more insight, and I think that's going to come out end of this month from memory. So that will have a big impact.
Yeah, there's a lot of the speculation is like, because I think broadly most people would agree with us that the inflation has been more or less broken, and that's going to be trending down, and we're going to be 2% within a year, let's say. And then the question becomes, when do they start bringing interest rates down, or will there be a second spike up in inflation like there was in the 70s? Here's why I think that that's not going to happen. I think the 70s are really every time there's inflation, they go, oh, it's the 70s again. And here's why I don't think that's going to happen. Firstly, so the first reason why is there's a lot more debt now. So we're a lot more interest rate sensitive. They don't need to take interest rates up to 20% to kill inflation. They can take interest rates to 5%, and the economy is going to be in a very different position. So we're lots of debt, very interest rate sensitive now compared to the 70s. The other probably more important factor why they can't do, well, there's probably not going to be another upswing in inflation, is that the demographics are very different. So we're a much, much older society, and the baby boomers in the late 70s and early 80s were all turning 30. So they're all getting married, and they're all buying their houses and all that sort of stuff. And so there was this massive sort of, we always talk about the basketball moving through the hose. I don't think so. I really think once they kill inflation, Grant Cardone said that within a year we're going to be begging for inflation, and he reckons we've way overcooked the inflation increases, the interest rate increases. So yeah, I just don't see a second spike up in inflation. I think maybe they've overdone it with interest rates, but we'll see. We'll see.
I think we certainly hope that's the case. Yeah, I mean, there's already a lot of people that's hurting out there. Even at the current 4.1% cash rate level, I can't fathom how it's going to be if it does hit the 5% level. So yeah, but look, I think the equation just comes down to how quickly it brings us down, like how quickly it goes back to the 2 to 3%, and maybe we will see. I mean, Greg Cardone is obviously looking at the US inflation data, slightly different to Australian data to that degree. So we'll see how it pans out. But
indeed,
yeah, no, I think it's good. It's good. It gives everyone a bit of breather, like you said, before they go back to the buffet table again, depending on which buffet table they want to go to. But all right, a bit of relief. So that's good for the mortgage owners. Now, how does this tie in to the CoreLogic data that we're seeing for July, I guess, to a degree? So, well, sorry, this is a retrospective one. So we're looking backwards at the moment. So the July data basically gives us what the period for June. So the CoreLogic data that we've got released on the 3rd of July covers up to pretty much end of June at this stage. And we are still seeing growth in terms of the property price values, but I think the key headline is the growth is slowing. So it's basically starting to turn essentially, and we can see that across multiple cities in terms of it's not going up as quickly as how they used to be in that sense. Although having said that, the numbers are still fairly strong. That's that's what we're seeing with Sydney up to about 5% for last quarter. So if you annualize that, that's 20%, which is
it's
mind blowing. If I in the current environment, right? So don't even know how to explain that. Melbourne though, Melbourne's an interesting story, and I think we picked Melbourne because we had a bit of a chat off air on this as well. The Melbourne median value as at 30th of June 2023 is about $762,000. If you compare that to Brisbane, which is sitting at $725,000 median value, there's only a gap of about 40, in fact, less than $40,000 in terms of that median. Now, traditionally, that spread isn't this close. So, I think we kind of both agreed that Melbourne could be presenting some really good values potentially moving forward for investors. John?
Yeah, I need to do my Melbourne to Sydney ratio, but I agree with you. I think that Melbourne right now is probably, and we'll do an episode on this, but probably the most undervalued capital right now. It was on parity with Sydney, say 3 or 4 months ago, but it really has been underperforming. You know what it reminds me of? It reminds me of about 15, 16 years ago during the mining boom when Perth prices were the same prices as Sydney prices. And in a sense, in the sort of hierarchy of values, Perth shouldn't be the same price as Sydney, unless there's some sort of economic anomaly like a mining boom. And Melbourne and Brisbane shouldn't be the same price either. In the sort of hierarchy of values, Melbourne should be more expensive. So you would expect to see that diverge. Melbourne should grow faster than Brisbane, and that would correct itself that way. But it's interesting to see that.
Yes. So yeah, look, I think we'll probably do the ratio video, I don't know, sometime soon. But when John's got a bit of time, I say. But yeah, I do anticipate that, using the comparison ratios, Melbourne would probably prove to be the most cost, got the cost price at the moment. But yeah, that's definitely one of those things. I think there's actually a couple of headwinds though. Speaking of Melbourne, we also touched on this. Couple of headwinds in terms of investors entering in Melbourne, because I believe they've actually put in place, or the 2023-2024 budget, they've actually put in place a bit of surcharge. In fact, I think it's called COVID surcharge. So they've reduced the land tax threshold from 300K to 50K. So in other words, pretty much all investors will now have to pay land tax. So that's going to impact a lot of people. And traditionally, the rent is already fairly low for Melbourne. So, you're talking about a low gross yield in addition to the annual land tax. That's the threshold being lower, which means now pretty much all investors have to pay a land tax. That's a double whammy for property investors looking to get into Melbourne. So the other side of the argument might be, yes, John, it's proving to be good value. However, with interest rate at 6 to 7% at the moment and gross rental return getting even lower because of the new annual rent, is actually a good time, or is it worthwhile? Because it's going to be a lot of cash flow negative properties in Melbourne in that sense. So
yeah, great point. No idea on timing, and I think you're quite right. I mean, capital flows to where it's treated the best. That's why the United States became very rich. It was very friendly to capital. Australia's been the same historically, and within the states, right now, Victoria doesn't have a particularly capital friendly government, but governments are temporary, so these things correct. But you're right. These surcharges and this sort of extraction process from the citizens that will weigh on the property market. But again, the people are moving through institutions, and Melbourne historically is clearly cheap right now.
Yep. So it's worth looking at, I guess. Other numbers. So Brisbane doing fairly consistent, still 1.3% for the month, quarterly 3%. Adelaide consistent 0.9% for the month and 2.1% for the quarter. Perth, 0.9% for the month and 2.8% for the quarter as well. Speaking of Perth, I think it might be worthwhile touching. Anecdotally, I'm hearing that it's very, very hot on the ground at the moment. Most investors are looking at Perth purely for cash flow or affordability side of things. Right. Just because people's borrowing capacity right now. So, so be careful if you are trying to enter into Perth at the moment, because chances are, number one, competition is fierce. Number two, there's no stock, which we will also touch on a lot. No stock. And a lot of demand for investors driven in the Perth market. So be prepared. If you are going to enter into that market, there's going to be a lot of competition. You're likely going to have to pay a lot higher prices, and you're going to have to act very, very quickly, in a sense, to win anything. So that's probably my key 2 cents for this month on Perth.
That's good.
Okay, so stock levels, actually. John, I know you've looked into this a bit for us. Stock levels remains to be very, very low. As a matter of fact, I think you've looked into the same time last year, because you're wondering, was it also like a shortage of about 20% last year? Tell us a bit more about that.
Yeah. So in the latest data set, the amount of stock is 20% lower than the same time last year, and 26.4 below the average of the last 5 years. So we're 20% below the same time last year. That's Australia wide. It varies per capita. 20% below the same time last year. What we did, as you rightly said, David, is we went back to this time last year to see if we were down this from the year before. So if I go back to the 2022 data, we were down 24.4% for Australia, and 25% for the capitals. So 20% down off last year, and then 24% off the year before. The amount of stock is about 40 to 45% below where it was 2 years ago. 40 to 45%. So, and there are more of us. There are more houses, and there are more citizens. There are more people, and so on. There's more capital looking for a home. Yep. So when you've got 45% fewer houses over the last 2 years, no wonder prices are rising. There's, even with the demand destruction that comes off doing 13 interest rate increases, 45% fewer properties to buy. It's very difficult to rebalance that. But that's the market doing the market's thing. The market is rebalancing supply and demand. So demand is way down, and so supply is reducing to meet demand. But yeah, so this time last year, the CoreLogic report said 24.4% down for Australia in terms of new listings. That's huge.
And that's the key reason why the prices at the moment are still going very, very strong, right? Yep. Because, like we touched on this a few times as well, with rising interest rate, reducing borrowing capacity, why is prices still continue to be pushed up and up and up? This is basically the main contributing factor, is the low stock level. And it's been consistently this case for the last, I don't know, since, like you said, 12 months ago. So for the last 12 months, it basically just has been keeping even lower in that case. So not many stocks available for people to buy. Demand is pretty much on average across the 5-year period, as far as I'm aware from CoreLogic data. So yeah, we are effectively seeing about like a 40-odd% in comparison to 2 years ago, right? In terms of the stock level. So pushing it up. And yeah, so the amount of competition is what's really driving up the prices. And I think, John, you've obviously been keeping tab on the Sydney markets. You can tell that it is really just comes down to competition. Most people, what do you think of the fear of missing out factor at the moment? Are you seeing, like, when you attend auctions, are you seeing a lot of people kind of like, like that fear of missing out feeling is coming back again in the current market?
Yeah, well, there's been both demand and supply destruction. So I'm not seeing a feeding frenzy at these auctions. 2021, it was a feeding frenzy. There was very high supply and very high demand, and I'm not seeing that, but I'm seeing consistently prices go over the reserve. I'm also seeing, the vendors are wanting to go to market. And actually what I've seen just in the last 4 weeks is that the vendors have woken up to the price reset higher. So now they're realized, the place across the road sold, let's say. So now my place is worth 300,000 more than I thought it was worth.
Mm.
And I have a very specific example in my head, which I won't share, but the vendors have woken up in the last 4 weeks that prices have risen materially, and they're actually not that far off the peaks from 2 years ago. They're not at the peaks, but they're very close. So yeah, I think so you asked about FOMO. Is there FOMO? No, there's not. There's no feeding frenzy in the demand side, but if you're a motivated buyer, you only have like one or two choices in your market. There's not a lot of properties out there, so you'll be a buyer for both of those available properties, let's say. Yeah,
just not many options basically. So they're forced to, in the current available stock, to pick and choose from what's available.
And the question now is, what happens in spring? So we're in the middle of winter right now. It's bleak and it's cold, and there's never much stock at this time. But the agents I'm talking to don't think it will improve in spring. They think that the supply will not come on board in spring, even though there are some vendors who are starting to test the waters and say, yeah, we'll be ready for the warmer months. It doesn't look like there's going to be enough supply that's going to come on board sort of September, October. So we'll have to wait and see, but this seems set in at the moment.
Yeah. Okay. All right. Which means the price, the uptight prices will probably hold on to its position, but just stay more flat, I guess, in that sense, isn't it? So,
yep.
Okay. So a couple of listings, rents. What about the rental growth aspect side of things? I think we're seeing the rental conditions have started to ease a little bit, or the rental growth has started easing a little bit, although the annual change in rents is still very, very high. We're talking about, in particular, Sydney units at 18.8% annual change. That's a phenomenal number, I have to say, basically. But look, the trend is across all the cities except for Perth. I think all the cities have started to ease a little bit. So they started to turn in that instance. And Perth is the only one that, from the graph perspective, still shooting up from a rental perspective. So I think rental growth there is still going to be continuing on for a little bit longer for units in Perth.
I'd also say, so Canberra's the other one that's an outlier on the downside. So Canberra house rent is down and it's flat for units. So everywhere else is up, but Canberra's underperforming in rents. Sorry.
So good. Yeah, no, that's okay. So good to be an apartment holder in the current city market at the moment,
that's right.
Isn't it?
That's right.
Although might not see that much capital growth, but at least from a cash flow perspective, hopefully it helps offsetting a bit of the mortgage repayments.
But you know what? Just in terms of units versus houses, and we'll probably do another data set conversation on this, but if we look at the last couple of years, for units, they never boomed in 2021. They never crashed in 2022, and they're catching a bit of a bid this year, but not as much as houses. They've actually, but underlying that, they've had the biggest rental increases. So total returns, even though there's been a bit of volatility, they've been far less volatile than houses, and the total returns have been quite good. I mean, particularly on the rent side. So real estate is doing what real estate has always done. It's actually fascinating to see. We're still, getting 5% growth per year in units on average, and 7% growth per year on average for houses. And you're getting inflation. There's been a big inflationary catch up on rent. So rents lagged CPI over the last 10 years, and now they're catching up. So over long periods of time, these averages just assert themselves.
That's true. The rent, the units feels like a bit like a slow and steady type of approach in Sydney. That is, can't say for all the markets, but it certainly feels that way. It's, in a sense, it's like Adelaide, actually. Adelaide has been pretty much consistent for, 1 to 2% kind of every year beforehand for houses. And now it's started to wake up. So I think the affordability is going to play a big equation moving forward,
Mm.
especially in the current environment where borrowing capacity has reduced about 30 to 40%. So most people can probably only afford buying in units or apartments, or forced to be only be able to buy units and apartments, and therefore, especially in the pocket of, I don't know, 700 to about $1 million, that's kind of the affordable pocket in Sydney terms, and that's where most of the units are kind of lying in terms of its purchase prices. So,
Yep.
Yeah. Now, any other things you want to cover from that report, John? Anything else I missed?
No. It's all about supply.
It is. I think that's the key. The key metric there is still the supply is the main issue here, isn't it? So, okay. All right. Well, let's jump into a bit of a topic of discussion for this week, I guess. We've been talking about interest-only repayment and principal and interest repayment for a while, and I know with the high rate environment right now, a lot of people are contemplating whether they should be continuing on their P&I repayment, or they should be looking at switching over to an interest-only repayment to help alleviate the cash flow perspective. Because as you can imagine, it's very, very difficult to hold a property portfolio in the current 6% to 7% interest rate, especially when you have multiple property portfolios, even make it even harder. So I guess the question comes down to, should you be looking at taking on, let's say, I guess two sides of the equation. First of all, if you're getting new debt today, or if you're purchasing new property, should you be sticking on P&I or interest only? And second part, I would say, is for your current portfolio, if you are a property portfolio owner today, should you be looking at changing your investment portfolio to interest only, or should you still keep them on a P&I level? I think that's the two key discussion points we'll touch on today, John. And look, we haven't spoken about this, so just for our listeners, this is very much live, right? Okay, I'm pushing these questions out. We haven't had any script or anything like that. I'm just coming up with these questions, and I thought they would be good discussion points in terms of giving. That's give our listeners a bit of indicators and pointers in terms of what we think.
Yep. Yeah. So, and we're talking investment properties now. So
investment properties.
Okay. So I'm very pro P&I. I'm very pro paying off principal, because I'm a bit old fashioned in general, and I like to own the properties forever. I want to own the properties forever if I can. So so firstly, paying off the debt makes it more possible for you to not have to have an exit that involves selling later on. Now, in real estate, a lot of leverage. And broadly speaking, the first 15 years of a 30-year mortgage, you're servicing interest, and in the second 15 years, you're buying the house, right? So it can be demoralizing, and what you want to do as a buy and hold investor is to break through that 15-year barrier, because then you're in a good spot. But you got to get there, and you got to be able to service it in the meantime. And the first 15 years, the first 10 years are not easy. Unless interest rates are dropping. So I'm a big fan of P&I. When you first buy an investment property, you're at 80% LVR. Now, if the value of that, you're actually probably a bit over that, because you've borrowed for stamp duty. So overall, you're at, let's say, 83% LVR.
Okay.
And from the perspective of your net worth, how wealthy you are, you want to get that LVR down. Right. So you want to get your equity up, and you want to get your LVR down. So the early years is actually quite important to start paying off your principal, because if the value of the property goes down, you might be at 85% LVR, 90% LVR. So all of a sudden you become quite high risk, and you can't refinance at 90% LVR. So the first couple of years, it's important to pay off principal. And I think you can put it on, and what we've done is we've put our debt on interest only later on, when the LVRs are at 30%, 25%, and the pressure's off. But in those early couple of years, you actually want to start, you want to give yourself a buffer, such that if the price of the property falls, and it will every, say, 5 or 6 years, that you're still okay. And again, remember, you're starting the ownership journey at about 83% loan to value ratio, LVR. So you're not comfortable until you're under 70%, and you've got to start by paying off some principal. So that's my view, and I think you can take your foot off the accelerator later on when it cash flows and you've got a lower LVR. But what do you think, David? And
yeah, look, I think I've got an opposing view to you, which is why it makes this discussion interesting. But first of all, I think I want to clarify that you can't actually borrow for stamp duty. So the lenders wouldn't allow you to do that. What you're referring to here might be you take equity out to pay for stamp duty. And in that case, then yes. But if you go up to the bank, if you ask them, can I leverage the property and borrow against stamp duty as well? They will say no. Okay. So I think it's important to distinguish that. Now, in terms of my stance, I can understand where you're coming from, John. Absolutely. You are trying to de-risk for the first couple of years and pay down the debt. Yes, absolutely. I think there's a couple of things to note here. Number one, a lot of my clients, when they're purchasing their first property, they are looking to be able to build their portfolio fairly quickly, because you want to be able to accumulate. During the accumulation stage, you want to basically reserve all your resources to be able to accumulate as much as you can, right? So, and most people, when it comes to borrowing capacity versus cash or savings, their cash is going to run out first, generally speaking, because we can structure the loans so that way they can go to tier 1, tier 2, tier 3 lenders. That way they can still got enough borrowing capacity to be able to buy their second, third, fourth property potentially. Okay, probably less people in today's environment, but by going on an interest-only loan, it allows them to be able to reduce at least the initial repayment, which means they can put more into their pocket, which means they can save up their deposit quicker to get into their second investment property. So it comes down to their goal. If someone is looking to be able to build 4 properties in, say, 5 years, then having an interest-only repayment on the initial loan is probably going to help them save up quicker than in comparison to the P&I repayment, to a degree. Okay, so that's the first thing. Second thing, I guess from a principal perspective, I'm a big advocate in terms of, we all are big advocate in terms of holding on property for a long time. Now, the reason why we want to hold the property for a long time is because we let inflation to eat and erode away our debt, basically. Okay, so yes, you certainly want to control your risk to a degree, and if you keep it long enough, you'll find that in 10 years time, 20 years time, even though the debt level, and if you don't touch it, the debt level may initially see as quite significant, but in 10, 20 years time, it will be seen as insignificant by that time, because, the money keeps losing value over time. So you basically help accumulate as much as you can, and you hold them on as long as you can in order to let the time or inflation to do the hard work of paying down the debt for you across the long term, in a sense. Okay, that's the second thing in terms of from my personal investment principle strategy. The third thing is interest only does give you some flexibility in the sense that we can use some non-bank tiers down the track to be able to help people accumulate further. So that's just from a debt borrowing capacity perspective. Okay, so with a P&I repayment, when you hit certain threshold because your repayment's been too high, you're gone, you're out of the game. So if we structure them correctly, it could be a difference between property 3 and property 4 as opposed to property 1 and property 2 when you get locked down in property 2. Okay, so that's from a borrowing capacity strategic perspective. And interest only, like I mentioned, tying back to number 1, you get to save up a bit more. Now, if you need to, and if you like to, you can always put that extra capital into the loan, paying it down. You got the option to, but you're not forced to, like as in P&I. Okay,
and we haven't talked about offsets yet.
We haven't talked about offsets as well. Correct. So if you chuck on the offset account, then again, different story. So so I think that's one of the reasons why I'm kind of more pro IO in that sense. But again, it comes down to each individual's goal. So I've worked with investors who I just need 2 properties fully paid off, and then I'll be happy to live on that kind of passive income. I said, well, perfect. First one P&I, second one P&I, off you go and pay it off. Done. You'll be done in 20 years or something, right? So But if someone comes to me and say, I want to be able to build a portfolio and have, I don't know, sounds vulgar, 100K passive income in 20 years time, of course, the first thing is to be able to accumulate to that level and have enough asset base before you can even consider getting closer to that level of passive income that you want at a later stage of life. So that's my thesis.
Yes. So I think you're spot on. I like how you sort of caveated it with, it depends on what the goals are and if it's like a rapid accumulation of assets. But I would say so it depends on how quickly you want to build up your asset base. I would say if you want to buy one property every 2 or 3 years, I'd be doing some P&I, and then you drop the first one off into interest only and then move the first, because I'm trying to de-risk the early years where you're very sensitive to price reductions. But if you're doing multiple asset purchases within a year or two, yeah, you can't even really do that with P&I. You'd need to be on interest only. I'd be skeptical if that's even a good strategy, but I am supportive, broadly speaking, of going big into real estate. One other thing I'd add is it depends on how old you are when you start. So I started young and went slow. Some people start late and have to go fast, and so that's when an interest only strategy probably works a bit better. But I'm really kind of, my view is very risk focused. I think you quite correctly put your finger on that at the beginning. It's like John's focused on de-risking a portfolio, de-risking the debt, and my view is always you come back to interest only later. So it's kind of that question. But I'm in a situation where we're happy to have our property portfolio mature.
Yep. So
we have the luxury to do interest only now. But that's what's worked for us. It's like you go hard paying off the principal early, and then you can park that process once you're not at 80% LVR. That's the risk that you're trying to mitigate.
Yeah, no, and I can absolutely see your point there as well. I guess coming back to a point, it really comes down to the age group of the investor. That was a key differences. If someone comes to me at 45 years old, I would probably say you need to start looking at some of the P&Is as well. It wouldn't be a great idea to just keep everything on IO, especially if they do not have an owner occupier themselves, right? That will be very risky lending in that case. But yeah, look, I was hypothetically assuming, someone maybe in their late 20s wanting to start building out their portfolio. They got at least 30 years of working life ahead of them. Yeah, time is on their side. So in that case, IO could be a great strategy for them in terms of being able to help them accumulate, build that base, et cetera, et cetera. But look, I think it really comes down to the investor appetite as well. Everyone is different. And I think so that's in the current lending environment, though. I have to say, John, it's very, very difficult to be able to build a property portfolio on a P&I repayment, especially in today's market because of cash flow. You're talking about 6%. And coming back to you as well, you mentioned in the start, it takes about 15 years roughly to kind of pay the interest, and then the next 15 years is where you really pay down the principal.
By the house.
I agree with you, basically. So the first 10 years, you'll probably see like most of your repayments going to paying down the principal. So the interest and not the principal. So the principal literally remained very much the same for the first 5 to 10 years. And some people might be pissed off with that to a degree.
Here's another aspect, and it comes down to, again, it personalizes this question a little bit. But if you're a good saver, you can go on interest only because you're parking your buffer in your offset. If you're a bad saver and you spend everything, you kind of need to go on P&I because there's no other way to build up the buffer. You need to go on P&I. So that I think there's that as well.
Money attitude, absolutely. I look at money attitude when are they a spender, are they a saver? If they're good savers, I usually go no problem with IO. But yeah, if they're spenders, I usually say let's put it on P&I. So that way, they're forced to save to a degree, and by putting money, reducing the principal will help them. One thing as well, John, I want to discuss with you. So you mentioned about earlier about the be able to refinance at like maybe at a second or first or second year stage. Now, if they're not looking at selling, or if their finance is in a straight, like is the price actually going to be, or is the purchase price or the value of the property going to be applicable at that point in time, I guess.
Well, are you saying that they would assess the value at the purchase price because it was so recent?
So if, let's say, for example, initially they purchased at 80% in using your example, but we say we took 5 years interest only, if they basically just focus on accumulating and continuing on in that instance without having to shift the first lender or move them away from the first lender, because usually when you start off, you're on probably one of the major banks or top tiers anyway. So it wouldn't be too difficult to hold for a long time. So in that scenario, why would you, I guess the question is, why would you need to look at refinancing in that scenario? If basically you're already, it's pretty well kept in terms of repayments, etc., etc. So
if you were to bring another property into the portfolio,
that's right.
That's why.
Yeah. Okay. So if you're looking at releasing equity, etc., etc. So yeah. Okay.
So here's one other aspect, because we've moved from one very particular interest rate environment into another very particular interest rate environment.
Correct.
So we've got, so the average borrower, let's say with the Big Four, has moved from 2.5% interest to 6.1% or something like that. It's a material change in the interest rate landscape, and it's a material change in the way we should be thinking about interest only and P&I. And it also sort of ties into, when interest rates are low, we should have all been saving, because that was a once in a lifetime moment of interest rates, saving or paying off principal. So my question is, should we have been saying to people to pay off principal during those 3 or 4 halcyon years of low interest rates, and is it more appropriate to go into interest only now that interest rates are higher and so on?
Oh, look, I think great question. If you have an owner-occupied debt, last couple of years was a great time to be smashing down that home loan. That definitely the case, right? I think I've been smashing down my P&I home loan for the last couple of years, so that's definitely helped. But from an interest, I guess from an interest-only perspective, okay, so my philosophy is this: if you've got owner-occupied debt, it should always be on principal and interest. So, and the money should always be kept against the offset account in that. Okay.
Right.
The only exception to that is if this is an interim home. So if you're looking at buying an apartment and this is not your forever home, then yes, you can probably keep it interest only, and then you can probably keep the offset account in there. So that way, you reduce your payment, but you continue to save up the buffer. So that way, when you are looking to upgrade, you don't need to borrow as much. Ultimately, the idea is to lower and reduce your non-tax deductible debt, the owner-occupier debt, and to maximize your investment debt, basically. Okay. The second part of the equation is if you're currently struggling, then I would definitely say yes. If you want to be able to hold onto the portfolio, look at changing the investment portion to interest only to help alleviate the cash flow perspective. And park the money in the offset account, because right now with interest rate around 6%, you're actually not paying much principal at all. So by putting those money in the offset account, it does help you paying down a bit more principal, and to reduce your overall risk. So that'd be my take at the moment. John, what do you think?
Yeah, I think you're right. There's a big chunk of repayment and this little bit of going to the principal. So I agree with all that. Having paid off principal also prepares you better for unexpected interest rate increases. So that's it. So they will be calculating interest off a lower balance because you did the right thing during the low interest rate period by paying debt off. But you're right. When you've got a large portfolio, you've got to triage what you pay off and what you leave as interest only. And you're quite right to say pay off your home loan. But the reason that you pay off your home loan is you want to pay off your most expensive debt first. So you want to pay off your home loan because it's not tax deductible. You want to pay off your credit cards because they're at the higher interest rate. And then you can have a think about 1 or 2 other investment loans if you wish. But you're right. You have to rank and prioritize what debt you pay off, and you pay off the most expensive debt first, which is usually your house.
And from borrowing capacity perspective, that makes a lot of sense as well, right? Because if you can remove that non-tax deductible debt component, in other words, that's a bad debt, because don't forget, all the other good debts and investment loans can be tax deductible and added back to help with your borrowing capacity. So it actually helps, a lot of people who have a fully owned home and then a couple of investment debt in that case. You'll find that, generally speaking, lenders are more willing to lend them a bit more, as opposed to someone who's heavily indebted with the owner-occupier debt and now looking to build a property portfolio. So from a borrowing capacity and number case, it makes total sense. So, yeah. Now, circling back to the question, whether people should be saving the last couple of years, I totally agree. I think they should have been, but whether that was the reality or not, I don't know. I think people are going back into the revenge spending because we've all been locked down during COVID for too long. Yes, we say half because we saved the hard because we don't have much anywhere to spend it apart from online retail. But that was a great time to be able to save up a good chunk of war chest and potentially pay down your home loan a lot quicker. So I do agree with you.
Well, as Gandalf the Grey said, you don't always get to choose the time that you have. All you can do is decide what to do with the time that you've been given, or something like that. Lord of the Rings. So you just have to make the decisions based on the current circumstances.
Definitely. So yeah. But look, I think that's great discussion. Thanks, John. I think hopefully that gives our listeners a bit of pointers and understanding. I think this is an interesting one I do want to bring up because I know, John, you have a bit of an opposing view to me, and I know you've always been very conservative when it comes to controlling risk. I'm probably a bit more risk. You're more risk averse than me, essentially. So, but I've got my less risky side too. So I think. All right. Well, thank you, listeners, for joining us another week. And as always, what we have spoken today are general in nature. If you've got any specific questions, please do check with your accountants, mortgage brokers, financial planners, etc., before making a decision on your investment journey. But other than that, have a great week, and we will see you guys again in another episode of Spark Your Fire. John and David.